Friday 29th November 2024 price action review. I'm going to look at the NQ today and specifically look into a 1 minute market maker buy model. I'm going to compare the NQ and the ES, its price action in relationship to this market maker buy model. Alright, daily chart. Price has been spending time in and around this daily CB for quite some time now. Let's see, 1, 2, 3, 4, 5, 6, 7, 8 candles have closed inside of this daily CB, so it's been really it's been 2 weeks, so that's pretty significant. We had yesterday a bank holiday and being Thanksgiving, and today we had another shortened trading day because of the day after Thanksgiving. So the market closed at I think it was 12:55. So that's that. But we continued its consolidation inside of this daily CB today. But it still managed to post quite a significant daily range in comparison with the previous 8 daily ranges we had. So, and that in a shorter period of time was pretty interesting to see. So price took out this old low on the 4-hour chart, the swing low, took it out, rejected. Notice how the candles bodies all stay above CE of the daily CB. That's still indicating that the price is respecting it. That is the daily CB CE level as a discount array. So this was like a clear indication to me as these candles close above. I was specifically looking for that. Once price took out the sell side, I was specifically looking if this 4-hour candle can close above CE. That would really support a run higher towards this old high and back towards that daily CB premium high. As this respect of this discount array would support bullish order flow, at least on the lower time frame, of course, because we are in a higher time frame consolidation. Okay, 1-hour chart. You can see the candles being more refined here than in comparison to the 4-hour chart. You can see price took out sell side here, and notice how the bodies closed above the sell side liquidity pool. That is like a beautiful signature you like to see when you are already anticipating to see higher prices to be unfolding next. So clear rejection and then a rapid expansion higher. But notice where it does occur, inside of this inversion fair value gap. First of all, price trades down into it first during the Asia session, then rallies up higher, takes out this buy side liquidity pool. In between the new week opening gap levels, it's really just spending time there, then drops lower again, taking out that initial low and digging deeper into that inversion fair value gap. This first low forms around the upper quadrant, and the second low that takes out the initial low comes really close to CE, but doesn't reach it exactly what we want to see. Also, when we are bullish, we want to see that CE level being respected, ideally not even trading there. If it does so, only with a wick, but here it really respects it as the wicks stay above CE of that inversion, and the bodies stay also in the upper quadrant of that this inversion value gap. So really nice algorithmic signatures. Then price expands higher rapidly towards these old highs here, and then something really interesting happens. Price closes above CE of the new week opening gap, opens up with the next candle, drops down into the same CE level of the new week opening gap, uses it as support now, and then rapidly expands higher towards the buy side liquidity pool I outlined on the 4-hour. but taking out underway these buy-side liquidity pools on the 1 hour, all LR signatures. Notice again how price initially uses this new week opening gap as a premium array to send price lower. Then once it takes out the sell side into the inversion fair value into a discount, is what I think. I'm not exactly sure either. It's like this is also discounted from this low to this high, definitely from this low to this high, and from the change in state delivery opening price to this high, it's also discount. Then the market expands higher like I outlined. Let's now look at the 50-minute chart. Okay, I first zoomed out to really define those liquidity pools. We had the Asia buy-side liquidity, which was like the simplest target that there was. Right, we have that market mechanics taking place here. Initially, buy-side gets purged here, right here at the new week opening gap CE. Then the market drops lower, takes out the sell side, so buy side first, sell side second. What unfolds then? SMT at the lows, at a discount array, reversal taking place, LRLR towards that initial buy side liquidity pool here. This typical market mechanics. Whenever a significant move higher is expected, you can also always expect some measure of sell side to be taken first before seeing the run up. The more detailed explanation is actually before any significant move higher is expected, a buy side liquidity rate is expected first, then a sell side liquidity rate second, and then a low resistance liquidity run higher towards buy side liquidity, right? The buy side liquidity is at the high formed prior to the run on sell side, so that is Asia buy side. That's where the turn took place. That's when price starts to deliver sell side. So that's the target, and that see how easily the target got reached here. Like it was literally SMT taking place at the lows, inversion got hit, which was this inversion, this nested 50-minute inversion for value gap, which resides inside of that 1 hour inversion. So SMT takes place 9:30 opening, initial drop down, rapid expansion higher, 1, 2, 3 consecutive large range candles. Buy side has been met, like the major strong liquidity for me. Then price dips also above this pre-market buy side liquidity from Wednesday, and then just really starts to slowly but surely gravitate also London buy side. Did actually quite significantly here still, but like the consecutive up closes were until it met this buy side draw. But this is like the ideal market structure for a which will set up a 1 minute market maker buy model, also a 5 minute market maker buy model, but I really looked into the 1 minute here, which that's what I predominantly use. I'm just looking for a 50-minute internal to external range liquidity, or external range to internal range liquidity, ideally in the direction of the daily or 4 hour Tron liquidity. So that's like A plus structure, because that will set up a 1 minute market maker buy model or market maker sell model, and that's where I execute of pairing up the sell side of the curve with the buy side of the curve in case of a market maker buy model, or a pairing up the buy side of the curve with the sell side of the curve in case of a market maker sell model. Entering short in the case of a market maker sell model at the low risk sell stage 1 distribution or second stage redistribution. That is and or, because pyramiding is of course a option in high probability. not even each, just on a stage of accumulation on the buy side of the curve of that 15-minute market maker buy model, you then drop down to the 1 minute and look for a market maker buy model there, really just trading just a stage of accumulation there on the 15-minute chart. So we then had we did actually had like here, price traded down into this order block, right, internal range, because the order block is internal range liquidity. Price drops down into order block, and then where can price go? External range liquidity, London buy side, Asia buy side. So we did have that fractal too, which I'm actually going to look into afterwards, after this video. But I pretty specifically looked into this smart money reversal area here to set up a stage for a 1 minute market maker buy model. But this is actually perhaps even nicer. But let's see. So we have here that 1 minute market maker buy model. Sell side get taken, SMT with ES. Price reverses at some initial whipsaw, which is to be considered to occur right at 9:30, which is what the case was here. The first minutes after 9:30, we just saw back and forth price action, but like I predominantly focused here on the bodies, because look at the bodies specifically. Where did they close? Above the sell side liquidity pool. What does that tell you? Now, when we have the narrative in place, when we are expecting higher prices as outlined on the higher time frame charts, price reached down into the inversion on 15 minute, took out sell side liquidity, took out Asia sell side liquidity prior to that. And we see these candles close above it. That's telling something. Then I'm just waiting for displacement higher. Which happened here. Notice this wick traded down again into that old low, sell side liquidity. Did not take out this low, so this forms a swing low here, which will actually become a intermediate term low, and even later on a long-term low. Why? You have a low here, short-term swing low here, swing low here. This will become this is a short-term low. This is an intermediate term low, because we have a short-term low to the left of it, short-term low to the right of it. So we have intermediate term low, long-term low, and we have another intermediate term low here, because we have a short-term low here and a short-term low here. So this becomes a long-term low, and this low should never be taken out if order flow is bullish until the draw has been met, which happens not even here yet. So, and it may even continue to expand higher. So as long as order flow is bullish, this low will stay intact. That is on the 15-minute chart, because that's where this low also formed, but definitely the 1 minute here. But back to the topic, we can see price shows displacement higher, and then starts to consolidate a little bit here, trading down into this upper fair value gap, leaving this gap open, which was the first presented fair value gap actually. So that gets left open. So why did it happen? Because of that upper fair value gap acting as support. This is obviously hindsight. However, we had this inversion fair value gap, which actually got traded back to the premium high that is, act as support as a discount array, setting price higher. So could price had traded down into this first percent fair value gap? Yes, it could. It could have traded down into it. Why? Because it is a discount from this low, dealing range low, dealing range high in that sense of a short-term manner. It could have dipped down into this wick, could have dipped down into this first percent fair value gap. I did not want to see, if that happened, it being completely filled in. That wouldn't be good, because this is also a balanced price range, because you have a SIBI and a BC overlapping that makes this balanced, as both sell side delivery has overed and buy side delivery has been overed, and then price moved away. So that wouldn't be good, but it could absolutely have reached down into it. It just didn't do it. So I thought of perhaps the reasons why this fair value gap didn't get traded to. It could be because of the time element. The market closed early today at 12:55, so perhaps the market was in a rush, and that was actually seen afterwards. We saw this rapid repricement higher, spooling higher, barely any down close candles, just one-way street higher until Asia buy side has been met and the pre-market buy side of Wednesday here. So that could definitely have been a factor, and also the volatility after 9:30. It's usually much more volatile, especially after a bank holiday. So it might not see deeper traces then, especially when the narrative is already in play of higher price to be seen next. You're already seen the smart money reversal here, already seen the low risk buyer. So yeah, then it can just really be in a rush to go higher. So to conclude, really, it could have traded down into this first percent fair value gap. It didn't have to because of the inversion again and this upper fair value gap. But predominantly the inversion. There was a long here. If you would have entered at the premium high, you would have missed it probably. You would have missed it really. Because of the spread, even in futures, you have like a little bit of a spread like for entering. So, we saw price respect this upper fair value gap, leaving it open, act as a breakaway gap, so we can expect this to act as a rocket fuel to really send price higher, which happened here. We saw price trade up, down to this inversion fair value gap, finding support there, and then just a rocket fuel being injected here and just rapid repricement higher. Notice when that rapid spooling event took place. 9:50 to 10:10 macro. That's just, isn't that amazing, to be honest? The market really started to spool higher once it took out this short-term high. Then it was like gone, didn't it? Much there, but it really just started when 9:50 to 10:10 macro began. It really just took off and just left that area here. That's also the significance of the new wick opening gap in this market maker buy model as part of the buy side of the curve of that 50-minute and 5-minute, which I don't have here, market maker buy model. It's just so interesting to see. Like price initially closed here above the premium high of the discount low of this new wick opening gap, but the next candle just opens up and then closes below it again. So that set up the stage for this retracement down into this upper inversion fair value gap. Also this inverse order block, it's still being respected here, by the way. But then price expands higher, goes again above the new wick opening gap discount low, and then the next candle opens up and also expands higher. It hadn't really left it, just going higher. This is the daily CE level, got easily traded through. Then price takes out London buy side liquidity, and then something interesting happens again. Should probably catch a drink, but okay. Price then expands higher above the London buy side and then comes back down. Notice where it drops back down into. This fair value gap. But what is so significant about this fair value gap? Two things really. First thing is obvious here. It overlaps with this new wick opening gap CE level, making it a very probable level for price to expand higher from, which indeed happened. Notice how only a wick really fills in that little fair value gap and trades down into that new wick opening gap CE level, and then the body's closing above it in this upper fair value gap. So if you would drop down to a 50-second chart, this will be an optimal trade entry idea. Then price expands higher, take out the London Asia buy side, and then we see some consolidation taking place, and that really just continues really until the close at 12:55, if I'm correct. of 12.59, something like that, shortened a day at least. But yeah, it was very interesting. But the second thing here was, by the way, that if we would measure from this smart maneuvers low, we didn't have like a clear original consolidation. Yeah, you could say here or the London buy side, but if you just measure from this low up to Asia buy of London buy side here, you would see that around 50% is retracement down into this fair value gap and then expansion higher. So that could also be of influence of why this was even more high probability, because yeah, it was just really good. You also had that old high overlapping here, so several factors converging and supporting the idea of price fanning supported this fair value gap and not trading down into a lower level. But the main one, of course, being that new week opening gap C level. So, but it is interesting to see though the difference that that was in delivery on NQ compared to ES. So that's what I'm going to look into now. So you could here very clearly see the difference in delivery. Both were pretty energetic to the upside, but ES actually did offer a opportunity at a low risk buy being here, using like the same idea that I had on NQ. So what we see here is that SMT taking place at NQ, also taking out a 50-minute sell liquidity pool, which I don't have on this chart, but it did take that out. We see 9:30 dropping down. This was like the Judas swing for the New York AM session. Like this was all it was necessary at 9:30 at least. Of course, you had at 8:30 this movement lower below the opening price, which was the manipulation for the New York session. But price then reversed, going higher, and notice then that price is spending time inside of the upper half of this inversion fair value gap. So I really looked into this, and it's really just accumulating inside of the inversion fair value gap before it even became a inversion fair value gap. So it's as long as price hasn't closed above the opening price, I would say, of the inversion fair value gap, of that gap high or gap opening here, right? Then it isn't really a inversion fair value gap yet. It's just a SIBI. So price just really accumulating inside of this SIBI. And notice also that this relative rebalance, which resides in the lower half of the SIBI, how price is supporting that with the bodies. They're all staying above it. Only a few wicks, being 2, reach down into the redelivered rebalance. And notice then that they also stay in the upper half of it. And notice then, even more interesting is how 2 of those wicks actually respect CE of that SIBI, which becomes a future inversion fair value gap. So this is like really a beautiful low risk buy really. We had also a immediate rebalance prior to it. So we had a SMT at the lows, change in the state of delivery, once price traded above this opening price. Traded, doesn't have to close, traded is enough. Then comes back down into immediate rebalance, bam. Expansion higher, but then hangs around a bit at that future inversion. Trades down into that releft rebalance one more time, and really nice expands higher. Comes back down one more time into this volume balance. This time comes down into this discount wick, inversion fair value gap, and then just a repricement higher, down into the expansion higher, down into this order block, breakaway gap, buy side being taken, and then just this pulling higher towards higher levels of buy side. So I didn't observe ES. I trade myself NQ, but I did look after the fact into it and just really living the moment. How would I enter here? Where would I place my stop loss, etc. So if I was observing ES and like the narrative I had in mind unfolded, and I would have observed ES with the idea of executing on it, the idea that I had, I would have had looked to enter long inside of this relived rebalance, and I would then have placed my the ideal way to place your entry was just at the premium high of that relived rebalance, and then I would have placed my stop below the mean threshold of this order block changed in state delivery order block. In other words, really, in essence, all order blocks are changed in state deliveries if they are valid in high probability in that sense. Not every down close candle is a bullish order block, but I'm going off topic. I would have placed it below the mean threshold, also to account for the volatility that is after the 9:30 opening. I think that would be fine. It could have been at the inversion for value cap low here. In this case, it could have even been here at the relative rebalance because of the immediate rebalance. In essence, immediate rebalances are like the crème de la crème, like the most beautiful stop losses you can have, because if you have an immediate rebalance, price should not come back down into the immediate rebalance candle. So it could have been here actually, and it would have been valid, not just because price didn't trade into it, but because of the logic. So I'm actually just looking at that now and realizing that that could have actually been a very tight stop loss and would have been valid, but this is really a very good stop loss also. Like it should never come back down to the mean threshold here, even with some wick or something. It's actually more the conservative side, but it's good. So that's the whole idea of this trade. I'm actually gone pretty off topic, and my mouth is very, 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 very dry. And yeah, I think that's gonna be it.